Hello everyone, I'm John Analyst. Right now, something significant is unfolding in the physical silver market that most investors aren't paying attention to yet. We're seeing delivery delays, premium spikes, and inventory drawdowns happening simultaneously across multiple exchanges and refineries. This isn't a single incident. This is a pattern. And patterns like this have historically preceded major price dislocations in precious metals markets. I'm going to walk you through exactly what's happening, why it matters, and what the structural mechanics of this market tell us about where we're headed. Because here on the Silver Reset, we focus on the data, the logic, and the market structure that mainstream media often overlooks. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. The silver market operates differently than most people understand, and the mechanics at play right now have serious implications for anyone holding dollars, bonds, or waiting on the sidelines. Let me start with the basics. Silver trades in two parallel universes. There's the paper market, where contracts representing millions of ounces change hands electronically on exchanges like the COMEX. And then there's the physical market, where actual metal has to be refined, transported, stored, and delivered. These two markets are supposed to stay connected. Price discovery happens on the paper side, and physical supply is supposed to follow that price signal smoothly. But that connection is showing stress. Over the past 18 months, we've seen something unusual. Premiums on physical silver products, the amount you pay above the spot price to actually get metal in your hand, have remained elevated even during periods when the paper price was relatively stable or declining. Normally, when prices fall, premiums compress because demand weakens. That's basic supply and demand. But that's not what happened. Retail premiums on silver eagles, maples, and generic rounds stayed in the range of $3 to $5 per ounce over spot for extended periods. Meanwhile, the spot price itself fluctuated between $22 and $26. Think about that. The premium represented 15 to 20% of the total price you paid. That's not normal. In calm markets, premiums typically run $1 to $2, maybe less. Now notice what changed. In recent months, those premiums haven't come down. In fact, they've widened in certain product categories. And at the same time, we've seen delivery times extend. Major online dealers who used to ship within 2 to 3 business days are now quoting 7 to 10 days, sometimes longer. Small delays can be explained by logistics or staffing. But when delays become systematic across multiple dealers in different regions, that points to a supply-side issue. Let me walk you through the numbers on inventory. The COMEX reports registered silver, which is metal available for delivery against futures contracts. Over the past year, registered inventories have fluctuated significantly. We've seen drawdowns of tens of millions of ounces, followed by temporary rebuilds, then further drawdowns. The headline number might look stable if you glance at total inventories, but registered versus eligible tells a different story. Eligible silver is metal sitting in COMEX warehouses that could be made available but isn't currently warranted for delivery. Registered is what's actually available right now. When registered inventories drop while open interest in futures contracts remains high, that's a structural mismatch. It means there are more claims on silver than there is immediately available metal to satisfy those claims if a significant portion of contract holders actually demand delivery. Historically, very few futures contracts go to delivery. Most traders roll their positions forward or close them out for cash settlement. The system is built on that assumption. But when even a modest increase in delivery demands occurs, the registered inventories can get strained quickly. Now here's where it becomes important. Industrial demand for silver is not discretionary. Electronics manufacturers, solar panel producers, medical device companies, they need physical silver to maintain production. They can't substitute it easily because silver's conductive and reflective properties are often essential to the application. When industrial users come to the market, they're not speculating, they're buying for immediate use. And industrial demand has been growing. Global solar installations have expanded dramatically as governments push renewable energy mandates. Each solar panel contains a small amount of silver. But when you're producing hundreds of millions of panels annually, that small amount adds up to significant aggregate demand. Electric vehicles use more silver per unit than traditional internal combustion vehicles because of the increased electronic components. The electrification of everything, from home systems to infrastructure, creates steady compounding demand for silver. On the supply side, primary silver mines where silver is the main product, represent only about 30% of total silver production. The majority of silver comes as a byproduct of copper, lead, and zinc mining. That means silver supply doesn't respond quickly to price signals the way a primary commodity might. If silver prices double, a copper miner doesn't suddenly produce more silver. They produce based on copper economics. This creates an inelastic supply curve. And when demand is rising from structural trends, while supply is constrained by the production decisions of base metal miners, you get a tightening market over time. Add to that, the fact that above-ground stockpiles of silver are far smaller relative to annual production than they are for gold. Silver gets consumed, gold gets hoarded. Look closely at this trend. Central banks have been net buyers of gold for more than a decade now. They're diversifying away from holding exclusively dollars and euros. But central banks don't buy silver. Silver isn't part of official reserves. That means there's no large institutional buyer stepping in to absorb excess supply when prices dip. The market is more vulnerable to swings driven by private investor sentiment and industrial demand. But here's the flip side. When private investors do decide to allocate to silver, there's no central bank selling to cap the upside either. The market is smaller, less liquid, and more prone to sharp moves in both directions. That volatility scares away some institutional players, which keeps the market thinner than it would otherwise be. Now let's talk about what's been happening with ETFs. Silver ETFs, like SLV or PSLV, are supposed to hold physical metal to back the shares they issue. When investors buy shares, the fund is supposed to acquire more silver. When they sell, the fund can reduce holdings. These flows give us insight into investor sentiment and physical demand. Over the past year, we've seen periods of significant inflows into silver ETFs, followed by periods of outflows. But even during outflow periods, the silver price hasn't collapsed the way you might expect if there was a glut of physical metal hitting the market. That suggests the outflows are being absorbed either by industrial users, by retail investors, or by other entities quietly accumulating. What we're not seeing is a flood of metal overwhelming the market. We're seeing a market that's digesting supply relatively quickly, even when investment demand temporarily wanes. That points to a firm underlying bid. Let me show you how interest rates tie into this. When the Federal Reserve raises interest rates, the opportunity cost of holding non-yielding assets like silver increases. Investors can earn 5% in a money market fund. Why hold silver that pays no dividend and costs money to store? That logic has kept a lid on precious metals during the recent hiking cycle. But here's what's changing. Real interest rates, nominal rates minus inflation, are what actually matter for precious metals. If you're earning 5% nominally, but inflation is running at 4%, your real return is only 1%. And if inflation accelerates, or if nominal rates start to come down, real rates compress or go negative. That's when precious metals historically perform well. Right now, the Fed has signaled it's done hiking. Markets are pricing in potential rate cuts over the next 12 to 18 months. If inflation remains sticky, which it has been in categories like food, energy, and services, then real rates could turn negative again. Negative real rates are rocket fuel for gold and silver because the opportunity cost of holding them disappears. In fact, holding cash becomes the losing trade. Now notice what's happening with the dollar. The dollar index, which measures the dollar against a basket of foreign currencies, has been strong relative to recent years. A strong dollar typically pressures commodity prices because commodities are priced in dollars globally. When the dollar rises, it takes fewer dollars to buy the same amount of commodity, so prices tend to fall in dollar terms. But silver hasn't followed that script perfectly. Even with a strong dollar, silver has held support levels that would have broken in previous cycles. That divergence tells us something. It tells us the physical demand and supply dynamics are overriding the currency effect. When a commodity stops responding to its usual macro drivers, you have to ask what's changed structurally. Let me walk you through the gold-silver ratio because this is critical. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere in the range of 50 to 60. When the ratio spikes above 80, silver is cheap relative to gold. When it drops below 50, silver is expensive relative to gold. During the pandemic, the ratio spiked above 120. That was an extreme dislocation driven by panic liquidations and industrial shutdowns. As the economy reopened, the ratio compressed back toward the 70s and 80s. Right now, it's hovering in the mid-80s. That suggests silver is still undervalued relative to gold on a historical basis. If the ratio were to revert to 60 and gold stays around $2,000 an ounce, silver would need to trade above $33. If gold rises to $2,500 and the ratio reverts, silver goes above $40. These aren't predictions. These are mathematical outcomes based on historical mean reversion. The question is, what catalyst drives that reversion? Here's where market psychology comes in. Most investors don't think about silver day to day. It's not on CNBC every morning. It's not a headline asset. But when gold starts making new all-time highs, when inflation fears pick up, when currency concerns resurface, silver comes into focus. And because the silver market is so much smaller than gold, when investor attention turns to silver, the price moves faster and further. We've seen this movie before. In 2011, silver ran from $18 to nearly $50 in a matter of months. That move was driven by a combination of investment demand, fears about currency debasement after quantitative easing, and a short squeeze on the paper market. The fundamentals today are arguably more supportive than they were then. Industrial demand is higher, supply is tighter, above-ground inventories are lower, and the macroeconomic backdrop of debt, deficits, and money printing is far more extreme. But here's where it becomes important to understand the mechanics. Silver doesn't move in a straight line. It consolidates, it builds energy, and then it explodes higher in short, violent moves. Those moves are driven by a feedback loop. Price starts to rise, momentum traders pile in, short sellers get squeezed, physical buyers panic about availability, premiums spike, and the move accelerates. Then it exhausts, corrects sharply, and consolidates again. If you're waiting for a smooth, predictable uptrend, you're going to be disappointed. Silver rewards patience during the consolidation phases and decisiveness during the breakout phases. The challenge is recognizing which phase you're in. Right now, we're seeing signs that the market is transitioning from consolidation to the early stages of a breakout setup. Physical tightness is increasing, premiums are elevated, delivery times are extended, investment flows are stabilizing, industrial demand continues to grow. The macro backdrop is shifting toward lower real rates. These are the ingredients. Let's talk about what this means for inflation. Silver is often viewed as an inflation hedge, but that's not quite accurate. Silver is a monetary metal and an industrial metal. It hedges against currency debasement, and it benefits from economic growth that drives industrial consumption. When you have both happening simultaneously, currency losing purchasing power and industrial demand rising, silver is in the sweet spot. The inflation we've experienced over the past few years isn't going away quietly. It's embedded in wages and housing costs and food prices. Central banks can raise rates to slow demand, but they can't increase the supply of houses or food or energy with monetary policy. Supply-side inflation is sticky, and the political pressure to cut rates, to ease financial conditions, to support growth is enormous. When central banks choose between fighting inflation and supporting growth, history shows they choose growth. They choose the path of least resistance. That means living with higher inflation, managing it, trying to keep it from spiraling, but not crushing it the way Volcker did in the early 1980s. Because crushing inflation requires crushing the economy, and no central bank wants to be responsible for a deep recession in an election cycle. So we're likely entering a period of sustained elevated inflation, maybe not 8%, but 3 to 4% instead of the 2% target. In that environment, holding cash is a guaranteed losing trade. Bonds offer minimal real returns. Stocks are vulnerable to multiple compression if rates stay higher for longer. Real assets, commodities, precious metals, these become the logical allocation. Now let's discuss currency confidence, because this is the deeper issue. The dollar's role as the global reserve currency is built on confidence. Confidence that the U.S. will honor its debts. Confidence that the dollar will hold its value. Confidence that the U.S. Treasury market is the safest, most liquid market in the world. But confidence isn't static. It's earned, and it can be lost. When foreign central banks watch the U.S. run trillion-dollar deficits year after year, when they see the debt-to-GDP ratio climbing past 130%, when they see political dysfunction around the debt ceiling, they start to question whether the dollar's privileged position is sustainable. We've already seen early signs of diversification. China and Russia have reduced their treasury holdings. The Gulf states are discussing trade settlements in currencies other than dollars. The BRICS nations are exploring alternative payment systems. These aren't existential threats to the dollar yet, but they're cracks in the foundation. And here's the thing about confidence. It erodes slowly, then all at once. For years, nothing seems to change. Then suddenly, a tipping point is reached and the shift accelerates. We're in the slow erosion phase now. The question is, how long that phase lasts before we hit the tipping point. Silver and gold are insurance against that tipping point. They're not investments in the traditional sense. They don't generate cash flow. They don't grow earnings. But they hold value when confidence in paper currencies wavers. They've done that for thousands of years across every civilization. There's no reason to think this time is different. Let me explain what this means for investor behavior. Most investors are reactive. They wait for confirmation. They wait for prices to break out before they buy. They wait for the narrative to be validated by mainstream sources. By the time that happens, the easy gains are gone. The first 20 or 30% of a move happens quietly, while the skeptics are still skeptical. The smart money doesn't wait for confirmation. They position ahead of the move based on the setup. They see the tightening physical market. They see the macro backdrop shifting. They see the technical base building, and they accumulate quietly while prices are still consolidating. Right now, silver is still in the accumulation phase. It's not on the cover of financial magazines. It's not trending on social media. Retail investors aren't piling in. That's actually the ideal time to build a position because you're buying before the crowd arrives. But accumulation requires patience. It requires conviction. It requires understanding that the market can stay quiet, even boring, for months before it moves. Most people can't handle that. They need constant validation. They need the price to confirm their thesis immediately. And when it doesn't, they lose interest and move on to the next shiny object. The investors who win in silver are the ones who understand the cycle, accumulate during the quiet periods, hold through the volatility, take profits during the euphoric spikes, then wait for the next cycle to begin. We're setting up for the next leg higher. The pieces are in place. Physical market tightness, growing industrial demand, constrained supply, macro backdrop shifting toward lower real rates, dollar potentially peaking, gold making new highs and dragging silver along, the gold-silver ratio poised to compress. These are the conditions that precede significant moves. Now let's talk about the immediate catalysts that could trigger the move. It could be a geopolitical event that drives safe haven demand. It could be a central bank policy shift that weakens the dollar. It could be a supply disruption at a major mine. It could be a large institutional buyer entering the physical market. It could be a technical breakout that triggers momentum algorithms. The specific catalyst doesn't matter as much as the setup. When the setup is in place, any spark can ignite the move. Trying to predict the exact catalyst is a fool's errand. What matters is recognizing that the conditions are ripe and positioning accordingly. Here's what I'm watching closely. I'm watching COMEX inventories. If registered silver continues to decline while open interest remains elevated, that's a red flag for potential delivery stress. I'm watching premiums on physical products. If premiums start spiking above the recent range, that's a signal that physical demand is overwhelming available supply. I'm watching ETF flows. If we see sustained inflows into silver ETFs, that's confirmation that investment demand is returning. I'm watching the dollar index. If the dollar starts to weaken meaningfully, that removes a headwind for silver. I'm watching real interest rates. If real rates turn negative, that's a tailwind for precious metals. I'm watching the gold-silver ratio. If it starts to compress below 80, that's a sign that silver is beginning to outperform gold, which typically happens in the later stages of a precious metals bull market. All of these indicators are interconnected. They reinforce each other. When they start to align, that's when the move accelerates. Let me be clear about something. I'm not saying silver is going to double next month. I'm not making specific price predictions or timelines. What I'm saying is that the structural conditions are in place for a significant move higher over the next 12 to 24 months. How that move unfolds, how fast it happens, how high it goes, those details are unknowable in advance. But the direction is clear. The fundamentals support higher prices. The technicals are building a base. The macro backdrop is shifting in silver's favor. And the physical market is showing signs of tightness that historically precede price dislocations. For investors, the question isn't whether to own silver. The question is how much and in what form. Physical bullion offers the most direct exposure and eliminates counterparty risk. ETFs offer liquidity and ease of trading but introduce counterparty risk and management fees. Mining stocks offer leverage to the silver price but come with company-specific risks and operational challenges. The right allocation depends on your risk tolerance, your time horizon, and your conviction level. But having zero exposure to silver in the current environment is a bet that none of the structural trends I've outlined will matter. It's a bet that the physical market will loosen, that industrial demand will decline, that central banks will successfully navigate a soft landing without reigniting inflation, and that confidence in fiat currencies will remain unshaken. That's a lot of bets to make on the side of the status quo. Here on the Silver Reset, we focus on the data and the logic because that's what survives volatility. Narratives change, sentiment swings. But supply and demand, monetary policy, and market structure, these are the forces that drive prices over time. What's happening in the silver market right now is a slow motion setup. The mainstream hasn't noticed yet. The headlines are still focused on stocks, on tech, on the latest Fed statement. But underneath the surface, the physical silver market is tightening, the imbalances are building, and when imbalances build long enough, they resolve violently. This is not financial advice. I'm not telling you to buy or sell anything. I'm walking you through the analysis the same way I analyze it for myself. You have to make your own decisions based on your own situation. But I will say this. If you're holding dollars, if you're sitting in cash waiting for clarity, if you're overweight bonds or overweight equities without any real asset exposure, you're exposed to risks you might not fully appreciate. Currency risk, inflation risk, systemic risk. Silver is a way to mitigate those risks. It's not a magic bullet, it's not without volatility, but it's an asset that has held value across centuries, across empires, across currency regimes. And in a world where debt is exploding, where central banks are trapped between inflation and recession, where geopolitical tensions are rising, having exposure to an asset that thrives in uncertainty makes sense. The silver market is small. Global annual production is around 1 billion ounces. At $25 an ounce, that's a $25 billion market. Compare that to the global bond market, which is north of $100 trillion. If even a tiny fraction of capital flows from bonds into silver, the price impact would be enormous. That's the opportunity. That's why this matters. Not because silver is going to save the world, but because silver is positioned at the intersection of industrial demand, monetary instability, and a market structure that's vulnerable to disruption. We're in the early innings. The crowd hasn't arrived. The premiums tell you that physical demand is real. The inventory data tells you that supply is tight. The macro backdrop tells you that conditions are shifting in favor of real assets. And the historical patterns tell you that when all these factors align, silver doesn't creep higher. It surges. Thanks for watching. Subscribe to the Silver Reset right now. Share this video with anyone who's paying attention to markets, to inflation, to the signals that something is shifting. Leave a comment below and let me know what you're seeing in your local markets, what premiums you're paying, what delivery times you're experiencing. Because this community is how we stay ahead of the curve. Stay alert. Because what's happening in the silver market right now matters more than most people realize. The setup is building, the fundamentals are sound, and the move, when it comes, is going to catch most investors completely off guard.